Hello and good morning to everybody. My name is Munyumba Mutwale. I'm your host on this morning's Behind the Markets. We would be joined by Vernon at some point, but welcome to today's show. This is your Finance Tuesday. I know you haven't seen me for a little bit of time. I had to take a little bit of a moment off, but good morning to everyone. If you are following us today on Facebook or anyone on social media, please drop us your name. Drop us where you're following us from. Tag your friends. Tell somebody. Let's get back into the flow of money today. Sorry about that. It being Finance Tuesday, we'll be going into some money advice. So we'll be looking at how to allocate money and manage cash. That's the big conversation point for today. But once again, welcome. Let's get started and let's bounce into some of the stories and some of the headlines, some of the market data for today, exactly what you tune in for. It is the 15th of May that we were covering from yesterday, and yesterday's market roundup did show that we did have a continuous slide in the Kwacha. We have seen it constantly losing value since that little run that it had all the way up to tax season. So for about a month, we've been seeing the Kwacha losing value, and therefore we've seen over the last 30 days, the dollar has a net loss of 0.58%, but really it has its year-to-date back up to 1.99%, with 1.44% up in the last week. It's in a buying position, as you can see. Though on the long term, we still have a negative slant to the dollar against the kwacha, but in the short term, we still have some strength on that. I'm going to give you some of my views on my expectations of where the currency is going. The Lusaka All Share Securities Index did close yesterday at 1,850, exactly where it was over the last 2 days, and it hasn't really moved over the last 7 days. We've seen that from the last 30 days, it's up 2.66% and up 11.08% year to date, while the bond index went up by 0.16%. Interest rates finally dropped below 24 for the first time in months. We've actually seen interest rates trading below 24, showing that there is bond buying happening on our markets, but a US dollar bond index is down 0.2% as of yesterday. Now, checking into where we are even against the Rand, we did see that the Rand picked up a bit of pace by 1.24%, but it has been trading on the negative as there is some negative outlook, especially with South Africa, with its relationship with Russia. Some of the main business leaders are concerned that the bad relationships that South Africa is starting to have with the US might affect it adversely and might actually start to harm its economic prospects. Remember that South Africa is the main investment link into from the US into Africa. Then again, South Africa is also taking in quite a bit of heat for its current support. Effectively, well, not really support, but its current position when it comes to Russia. So you are starting to see that the Rand is starting to tremble a little bit, and that's why it's still holding negative, even though the dollar has been on a strong recovery. As you've seen. And now, year to date, obviously, South African Rand is down 9.62%, but year to date, the dollar is up about 2%, meaning that cross-border trading still has a good discount attached to it. GRZ bond index was up, as we pointed out, 0.16% year to date. Bonds are up 10.32%. While in dollars, they're up 8.22%, but they were down 0.2% yesterday, with interest rates down 0.006%. While on the year-to-date interest rates are up 0.35, in other words, 35 basis points, meaning that over the last period, we actually have been seeing the interest rates holding quite strong. So it's getting into a much better position, but it's going to take some time to undo those high interest rates that we've had in the market unless we get a flood of investor capital coming back into our bond market. That's a big difference. But for now, bonds are still the strongest game at the moment, or at least the baseline game at the moment for cash flow purposes. And on the commodity market, we have seen that oil went up a little bit yesterday by 0.6%, mainly because of the strategic petroleum reserve purchases by the US, but oil is still down 12.44% year to date. However, copper went back up about 0.13% on hopes of Chinese data, but did unfortunately experience a sell-off this morning back down to the 8,000 on a weak Chinese recovery, while we're seeing gold continuing to go up 0.18% and up 10.8% year to date, mainly because we're getting closer to the US debt ceiling talks. So we are starting to see that trudge along to the uncertainty period. Now, gold, I always tell people, is something you want to hold as the minimal point. Now, in terms of your wealth insurance assets, we are seeing that wealth insurance assets, Bitcoin was up 3.2% on the debt ceiling talks, 2.2% up on Ethereum, and 0.77% up in gold in Kwacha. Year to date, gold in Kwacha is up 13%, Bitcoin up 5.612%, and 6.82%. Now, I want to park on this page for a little bit. This is what we call your wealth insurance. And I always have to try and give this disclaimer, people. The reality is that these are assets that are invested in specifically just to try and hold the line a little bit. It's not really investment in these assets to try and improve, to try and grow your portfolio in terms of, because these are high risk assets. Okay, they are high risk. Now you want to try and hold them just to balance out your portfolio, especially down the line. And I will enter some of these questions. I will enter some of these questions at the moment, but you want to hold on to these just in case there is some volatility in the market, like there is right now. The market is in a very defensive position, but these are not strong assets. They're very emotionally driven. They're very volatile. They swing quite strong. So this is why you always advise to hold no more than 5% in gold, 5% in cryptos and experimental assets, and then at best, if you want to start holding 5% in commodities, that's your cattle wealth, all sorts of other things. That's your mainstream portfolio. By the way, if animals are your main line of business, that's a different conversation. But if that is just the way you store wealth, okay, storing wealth, not the mainstream line of business, where you just store wealth, you just do about 5.55%, and 85 goes into the mainstream assets, whether it's your rental property, stocks, bonds, unit trust. That's the main things that you start dealing in. But whether you're even doing a bit of the fixed income game in a different way, but you keep about 85% of your portfolio sitting in stocks, bonds, unit trusts. So stocks, bonds, unit trusts, and property. That is the way you will store your livable wealth, that your passive income wealth that you'll hope to live off at one point. So this is how the markets are looking altogether in terms of where they are year to date. You are seeing that bonds up 10.3%, 4.2% year to date. Stocks up 11.1%, up 5% year to date. The US dollar up 2%, but down 4.1 in real terms year to date. And gold up 13, but up 6.9% year to date. Now, Bitcoin and Ethereum, as I said, very highly volatile. They can actually have a little bit of a problem later on in the market. So now getting into my mid-month read for oil. Yesterday was the mid-month point. So we're getting closer and closer. We are expecting pump prices to come down by about 0.82%, mainly because Brent prices are down 9.97% and the Kwacha is down 2.28%. So that should push the pump price somewhere down by 2.69%. That's what we should be expecting in terms of the pump price. So this is what we're looking at so far, especially over the last period. What we've been looking at in terms of this. So the expectation is that we should be seeing a 2.69% drop in the pump price coming up if we don't see much more aggressive movements by the ERB like we saw last time, where they held the price flat when they could have actually dropped it on the claim that it didn't trigger the 2.5% band. Well, we'll see how this month goes out. We are starting to see oil pick up because of the United States Strategic Petroleum Reserve purchases, and we are starting to see the Kwacha losing value again. So these are some of the questions and debates that we're starting to deal with. Now, let's take a look at our four horsemen. This is where we're looking at some of the data that we've seen. One, we saw Nigerian inflation continue to rise. That was a continued move up, while we saw Botswana inflation also continue to decline. German inflation slides down annually and monthly, while Indian food and fuel inflation continues to drop. So the mainstream countries are starting to come down with inflation. Short-term interest rates in America did rise did decline. Sorry, there's a little bit of a typo there. Chinese fixed asset investment year on year dropped to 4.7%. They were sitting at about 5.5%, dropped to 4.7%. That's a little typo that we have there. Chinese unemployment dropped to 5.2%. That's good data. While Chinese retail sales year to date also went up 5.7%, and Chinese retail sales generally went up by 18%. So retail sales year to date up 5.7, General retail sales for April were up 18% when they were expected to be 21%. Canadian housing was on the rise, while Chinese industrial production up 5.6% versus 3.9%. However, in the negatives that we're seeing in the industrial sector is New York manufacturing index shows a decline in the manufacturing outlook. Japanese machine orders were also down, and European Union industrial production also in the decline. So we're seeing some mixed data that affects things like copper. For example, in the industrial growth in the global side, we are seeing China giving mixed reads of its economy. Its housing market did push down with fixed assets coming down, fixed asset growth slowing down. Retail sales did come in strong, but not as strong as expected. And we are starting to see short-term interest rates starting to slide down in the US. So this is good data. This is some good data that we're starting to see, but there is some negative swings to it at the moment. So we have to pay strong attention to where we are going. Now, today, as we get touched up quickly, there's gonna be one major conversation that we will look at as we go into our deep dive story. But we do have one question here from Mr. Wix Muluba, who has asked, what will happen to Zambia, to the Zambian kwacha, if the US defaults on its debts? Well, if the US defaults on its debts, what you're going to find is that there's going to be a lot less money floating through the global economy. If America defaults on its debts, then it has a problem with bond buying. Once it has a problem with bond buying, then what you'll start to see is they're less likely to push their interests into our market. Their stock market will trigger downwards. Their bond market will go into a sell-off. Interest rates in America will start to rise again. And that will actually cause a problem if they get graded into default. It happened the last time in 2011, so we're just trying to avoid that as a global economy. I think that's just something we're trying to pay attention to globally. Now, going into our deep dive for today. Our main story for today, actually, that we are paying attention to, has got to do with fertilizer industry. Now, there is a statement that Zambia is set to become fertilizer self-sufficient in 30 months' time. So, according to a statement that was issued regarding the United Capital Fertilizer Plant, Zambia currently consumes 800,000 metric tons of fertilizer annually, but the United Capital Fertilizer Plant Phase 1, which was completed in September 2022, was able now to offload 300,000 tons of metric tons of fertilizer. And it did actually pump some of that into FISP, though we should have seen that reflecting in the dollar. Phase 2 is set to be completed in about 30 months by 2025. And this target will give Zambia self-sufficiency and less pressure on the FX rate, coinciding with the Angolan debt deal. So this is actually some good news in the long term, okay? In the long term. And I'm going to stress this point again. In the long term, when it comes to investing. Okay, when it comes to the kwacha, not in the short term, not next week, because the moment we say those are some good outlooks for the kwacha, we're expecting it to come down next week. No, you got to stop getting excited like that. It's not how currencies work. These things back into directions. They move gradually. They're like a ship. They actually take time to turn. Okay, and I know, yes, there's pain that you're feeling now, and you're trying to get that to stop right now. But unfortunately, that's how you don't methodically fix these things with instant relief. That's not how it works. I know politicians have convinced you that's how that works. And that's the reason why fixing the currency has never worked. Because you've been told all the time that it's always a short-term fix that you need, and somebody next week is going to resolve all your issues. It's not going to happen. Okay, so let's have a conversation about what this means in the medium term for the kwacha. Now, there are some areas of our economy where I do foresee certain issues that are going to be arising, and that's mainly because I do foresee that the currency is mainly driven by import and export factors. So one of the first things I want to just say is there are three trends that speak against a strong dollar in the long term. Okay, the first one I'll tell you is Sonangol Lubito refinery project set for 2026. Now that's supposed to cheapen the cost of import of oil. And why is that important? Because oil is our biggest import. It is our biggest import. So if you can get the price of oil coming in cheaper, finished product oil coming in cheaper. By the way, Angola gets its oil out at a much cheaper price, even without the subsidies. Okay, so if you can actually get it here at a much cheaper price, and we have made the investments, and the scheduled project is expected to finish in 2026, so then that means that the pressure from the oil price starts to push back downwards a little bit. And there is the expectation that oil prices will also start to come down around that period due to the global EV takeover as well. EVs will start to play a more dominant role from about 2025 going up to 2030 to 2040. That's when you're probably going to see the transition between the mainstream cars and electric cars, because most of the main car providers would have switched. They actually would have done the full switch. So in these next 7 years, we're actually going through a transition as a world, and you'll start to see the transition becoming much more pronounced between 2025 and 2026. So two forces that are going to be pulling: oil prices pushing down because of the EV transition, while at the same time you will start to see that this project should then kick in. So these two forces should push the oil price down. Therefore, the dollar demand that has to be allocated to oil then starts to come down. So that's the other side of 2026. These are methodical changes. Methodical changes. You have to start looking at these things because these are systematic issues, or some say systemic issues, that actually create the weak kwacha that you've all been complaining about. Okay. The second thing we have to start looking at is also this UCF fertilizer project, which is scheduled to be completed by 2025. So if we have self-sufficiency of fertilizer at the same time, 2026, we're then able to curb a lot of the expenditure on oil as well. These two things converging on one another should actually then strengthen the currency systemically, and therefore put Zambia in a much stronger position, one, to be more attractive for investment activity, and also to give us a stronger upper hand on trade. It might give us a problem on export. That's where the problem starts to come in. But I'm just giving you, that's the outlook. That's why I wouldn't peg my hopes on trying to store wealth in dollars, especially over the next 5 years. You might be shooting yourself in the foot. The next one, the final one I am going to point out, is EV renewable copper price, which is expected to be trading somewhere between 11 to 15%. Now, remember, and this is somewhere from 2025 to 2030, plus you've got a Kansanshi 3.3% ZCCM royalty that is going to be in play, meaning that you've now got a situation where more dollars are being captured back into the system. So you've got the tax that's going to come in. So you're going to have a higher price scheduled between 11 and 15. You've got dollars, so therefore even the regular royalty tax should be able to recover. But at the same time, you also will have a 3.3% that Kansanshi are busy now paying off to ZCCM, giving them that direct access to those dollars as well. So those two things in play will then create a bigger inflow of dollars, because remember, quite a huge chunk of your dollars come from the copper trade. Okay, so copper trade is a very important part of where your dollars are actually coming from. So we're looking at the outflow of dollars should be scheduled to start decreasing because of the first two factors, and the inflow of dollars should be scheduled to start increasing. These are systemic changes that should then reflect in a much more stable or stronger currency from 2025 to 2030. Okay, so that's a long-term picture. What's it going to look like in the short term? Your guess is as good as mine, because currency projections in the short term, very volatile, very mixed. All sorts of things can happen. Don't ever let anyone try and fool you to telling you where the currency is going to go in the next couple of days. That is a difficult thing. Okay, anything can move a currency in the next few days. It can be a debt deal, all sorts of things. These things can happen, but you have to kind of grit your teeth and look for the next 3 to 10 years. That's what we've got to start looking at. If you are able to start making 3 to 10-year investment decisions on that horizon, then you start to understand what you'll be doing with your money in a much better situation. But if you're trying to make emotional decisions very quickly, unfortunately, you're most likely going to lose money. That's what happens to a lot of people. Right. So those are my outlooks. And it's going to go into my chart of the day. So my chart of the day here, and forgive, I think the way the logo is kind of just blocking it out here. This is what we call annual imports that we actually got for a while. So one of the mistakes I think we always try to do as a country is that when we're trying to increase our currency, we're always looking at what we can export. One of the things we should actually be doing is what imports can we replace? What investments can we be making? The reason I say this is it is evident that our people already, when you're importing something, it's evident that you already have a domestic demand a domestic demand for it, and you're less inclined to deal with long-term supply chain issues or high-costing supply chain issues. So if our people are already importing something, it means we should be producing it and minimizing what our people are importing. So that's why the first target, which was a $250 million import, by the way, I think this was up to $500 million of late, is fertilizer. So this is the importance of fertilizer now being domestically produced. By the way, this chart is exclusion. It's excluding oil. This is non-oil that we're looking at because we can't produce oil. These are the things that Zambia is likely to be able to produce. Okay, if we could, we have the resources to produce. It's just that we can't produce oil here. I know there's stories that yes, there's oil somewhere, yada yada yada. You haven't found it yet. The point is, let's look at the things we have. All right, fertilizer, we can produce this. In fact, we've actually gotten to a point where we are producing it. So there's the conversation right there. You knock it out, you're able to take off something that import. Food stuff, we have to start looking at making sure we're producing food domestically. We are importing too much food internationally. We need to start making sure we're producing as much as we can domestically. Medicine's a little bit difficult, though we were talking about trying to get some of those plants here to go through it. And textiles is a conversation we've been having for a long time, which is based on the passing of the Industrial Hemp Act. Hemp is the thing that you use to produce textiles. If you're talking about producing textiles in this country and producing clothing, you're talking about producing school uniforms for the millions of children that are going to be there. You're talking about producing military uniforms. You're talking about producing police uniforms. You're talking about producing mining safety equipment. You're talking about producing farm overalls. Through the industrial hemp industry, you can produce all of this. In addition, through the industrial hemp industry, you can also produce fertilizer so that you're not just producing enough fertilizer for the country, you can actually produce fertilizer to export to the next door neighbor markets who will need it as well. So the top 5 for me are the ones that we really, really have to pay attention to. Fertilizer, foodstuff, medicine, and textiles are seriously important in trying to get our currency down. This, in addition, with the Angolan oil pipeline and the project there to try and get that oil moving, flowing this way. These things in addition, that's how you systematically bring your currency into control. So import substitution or alterations of the import supply chain. And I will say this, export growth is a natural, and I'm going to quote what I've written here, wrote this actually at the beginning of last year. Export is a natural evolution of people who are productive, innovative, and competitive. Before we start looking to expand exports, let's start by grooming and creating entrepreneurs to pursue import substitution. And this is the hit list that I've actually put that we should be going after. So this is a hit list to try and help this. And we can see that there are policies already being set for fertilizer production. There are policies being set to help with importing of machinery for food production. I know they did it with milk, all sorts of things, because we import 80% of our milk in this country. So trying to make sure that we're importing less things that we eat, less things that we produce food with, less medicine. I know that one's a bit difficult, but textiles, that's the one where I think they're tripping on their feet, okay, because they're failing to just pass that simple act. I know that it's there and everyone's going to start saying no, but it's a cannabis issue and all that. Yes, but it's being complicated for no reason. It is being complicated for no reason at all. And it's actually ruining a lot of what could have been a simple policy to improve the country simply because we're deciding that what is politically expedient. And I understand why everyone is always afraid to have the conversation about politically expedient. No, you don't want to give the past administration credit for anything. I think it's in this administration's best interest, especially on that law, to put the politics aside and put the country first. It's in their best interests to do that. Okay. And it appears that just getting a bunch of ministers to meet about how to actually progress the agenda of putting the Industrial Hemp Act, nobody's actually even talking about cannabis at the moment. Okay. That's a very difficult thing to do right now. Medicinal cannabis is a wonderful opportunity, but it requires so much when it comes to actually managing it correctly, that one of the best opportunities to first go for is industrial hemp because you can't smoke it. It's not a drug. It was just a mistaken thing. All you have to do is grow it for fertilizer and grow it for textile production. If you can do these two things, and on top of that, by the way, it also plays the role of becoming commingled product that you can get, because you can also use it for ethanol production. You can use the hemp stalks for ethanol production that you can use for the commingling process that we're also trying to do to bring the price of oil down. So these are the three attack points that you can utilize with it. The rest of the other products, I think, are a little bit more difficult to do. Fruits and vegetables, I know that we're trying to get a lot more fruit and vegetable growth. Animal byproducts, wood has always been a tricky conversation in Zambia because we still export wood and import toothpicks. We're still trying to figure out how that mess is still happening as a country. So that's our main conversation point when it comes to the FX rate. In the long term, I will say this again. In the long term, it is probable that our FX rate is gonna hold a strong line, similar to what happened, I think, under President Manawasa's time. And what I am foreseeing in a lot of these conversations, I know that we're talking about debt, we're talking about all these things. The benefits and the fruits are probably only going to start showing in about 2025. Okay, so you really have to push out your expectations. The benefits and the fruits really are only going to start looking like they're probably only going to be seen somewhere on the other side of 2025. They could come earlier, but really you have to just manage your expectations when it comes to the markets. Now, positioning yourself early is exactly how you want to try and do that now. So let's get down to our topic of discussion today. We are talking about financial. It is Money and Finance Tuesday, where we will be going through the topics. And part of the baseline of the pyramid of money is to deal of wealth. The wealth pyramid is to deal with cash. Okay, so the first step to doing things correctly is good cash management. All right, so I already want to push this out to everybody. Good cash management. So, what does that look like? What does that entail? How does that start to work out for you? So, let's play a little game here on good cash management and what we should be looking at doing. So, I'm going to start by giving you the 4 principles of good cash management. And what I'm talking about is money. The 4 principles of cash and money. 1, you get it from work. Trying to convince yourself that it comes from anywhere else is where most of your problems are going to come from. You're going to take exorbitant levels of risk, which are going to do to harm yourself, when really you want to make sure that you're getting your money from work. The second thing you do with money is you budget and spend it wisely. Okay. 3, you store it for insurance. And 4, you don't waste it on silly debts or things. These are 4 things that we're going to talk about now, going to these last 10 minutes, so that you can understand how to get better with this, because this is where the majority of the bungling is happening. This is where the majority of the issues are starting to play out. It's where we're not managing these 4 things. We want to be wealthy. We don't want to do these 4 things. We don't want to work for our money. We don't want to budget it wisely. We don't want to handle it for insurance purposes. And we want to get into whatever silly escapades we want with it and still not face the consequences. I think we all know that we are all very guilty of at least one or more of these if we are still struggling with these areas. Okay? If we're not seeing our wealth outcomes, these 4 areas are usually the area where this needs to be fixed. Now, the good thing about people who build wealth is they do 2 things well. 2. They make money and they allocate money well. These are 2 things they do. The rest of the things are out of their hands. Like investing, they put the money there, but the asset then grows on its own. And they're just diligent about making sure they're putting money into assets. The second thing they also do is they structure it. Yes, that's good. But really, they know how to make it and allocate it. And they allocate it intentionally and purposefully, and they allocate it wisely. And this is where, if you want to go back to the genesis point of everyone's issues, it's always one of these 2 things. You're not making it and you're not allocating it. And if you fixed one of these 2 things, you'd probably find that everything else flows with it. So that is what we need to start talking about today. So talking about the act of making it. Okay. Now, I've talked before, even on God's Economy and this, about the act of make money skill. And that is simply finding what you are good at and solving it for people who have a problem in that area. Okay, so what is your skill? What is your proficiency? Find out what your proficiency is. Find the person. So there's two pursuits you need to have. What am I good at? What do people need? What is the overlap between those two questions? Once you have found the overlap between those two questions, you can then proceed to sharpen your axe in that area. Become so good they cannot get rid of you or they cannot ignore you, as Cal Newport says. Build up your career capital. Your career capital is your know how, your know why, and your know who. Okay, that is a very simple thing. Somebody write that down in the comment section for me so that I know that you're paying attention. Career capital equals know how plus know why plus know who. If you know the right people, if you have good mission orientational meaning behind what you're doing, and you know how to do something, you constantly actually can generate money. That is how you make it. Okay. You make money by being a solution to someone's problem, either through a job at a company, either through a self employment or a gig when people need birthday cakes. You know how to make them and you know who to get stuff from, and you've built this very good network and you can bake your own cakes in your house, make a lot of money doing that. Or you've started your own business where you can where you can actually create a system for creating a product or selling a product out in society. So that's really what you want to focus on. Your know how, know why, know who. And if you can now push that out to people, that is exactly how you make money. Okay, you make it by going to work and then working on people's problems by being the solution to someone's problem. So that is the skill number one. You get money from work. I know we are all told that you can get money by giving it to online farming deals. You get money by investing it here and there. You get money by, you can store money by investing. Okay. You can grow your money by investing, but you make it by working. So this is what happens to people, and and unfortunately, these are the cautionary tales that happen to a lot of people when it comes to trying to take shortcuts in the money conversation. And I think we've been seeing it with a lot of people who are caught in these schemes and scams, which they get nailed for. If you are not willing to work for money, what happens is you end up taking exorbitant risks, and those risks end up losing you a lot of money. You lose a lot of money due to your unwillingness to work for it. Okay. You place it when you know and you've mastered how to make money. Master this, people. You must master this. Once you've mastered how to generate money, then you can go on to store it correctly. But you must master your engine of making money. Right. So the first thing you want to do is you want to make sure money comes from work. The second thing you want to do with money is budget it wisely. So let's talk about this conversation about budgeting wisely. I'm going to give you what I call the investor's budget guideline here. And the first part here that we call is your work section. Okay. You receive your income or your inflows, whatever it is. And you make sure you pay three things: your taxes, your tithes, your statutory fees. You pay those things. Last thing you want to be doing is dealing with the tax man. Those guys are dangerous. Um, so make sure that's dealt with. The first place you allocate. This goes against your intuition. It goes against your feeling. You deduct your essential savings and you make your investments. That's your first game. Your essential savings are your emergency cash plus your wealth. Okay, where you're targeting to build your wealth, your emergency cash plus your wealth. You put this aside, your retirement savings, your wealth buckets, you put it into there, and your emergency cash. These are two critical areas that you want to try and build your wealth in instantly first. So the first amount, decide how much you're going to be putting aside and pump it into these two areas. Remember that you want to get to 3 to 6 months emergency savings, and you want to make sure that you're dealing with, you want to be on track for your wealth building. The second place you want to start putting your money is essential spending and insurance. So this is the order you want to start doing it in. The first thing is your four walls. Deal with your food, utilities, housing, transport, clothing, in that order. Okay, in that order, and place it where it needs to go. Right. buy my food, pay utilities, housing, transport, clothing, knocked out. Once you've got these four, you are in a state of calm. Then basic insurance. Okay, you want to make sure that you've dealt with basic insurance, right? So this is your health, life, disability, your funeral policy. If you have property, if you have vehicles, that's especially vehicles that are essential to how you make money. Listen, people, not vehicles that are just fancy, vehicles that are essential to how you make money. Okay, that's what you focus on. Then you allocate to your essential cash reserves. Okay, that's where you also, and then plus also your college savings for your children. So essential cash reserves, things like college savings, that's what you're looking for. Now we start going into making payments for low interest debt. By the way, before when we're talking about essential savings and wealth, personal wealth buildings, if you've got high interest debt, you're knocking it out right there. You're knocking it out at the top here. Okay, where I'm talking about your wealth and retirement here. Number three, if you've got high interest debt or anything that you have, you're paying it there. Okay. Because trust me on this, the return on investment on paying for some, you owe someone 30% interest, the return on investment of paying that off early is actually much higher than any investment you can make. Okay, so you want to make sure you knock out your early debts, your high interest debts there on line number three. Line number five is also where you now also want to include home building. If you want to start building your home or saving towards building your home or your home ownership goals. Remember, it's harvest, health, higher education, home ownership, huge purchases. So number five is where you also want to start dealing with that. So if it's low interest debt, such as a mortgage, maybe you've gotten access to, or a home ownership project, that's what you want to start looking at. Number six is deduct and place discretionary savings. So discretionary savings, such as reserves for personal property maintenance. Remember, I said if you own anything, a computer, a phone, anything, you have to start putting maintenance money aside. Okay, because you're going to have to spend about 5% the value of that thing to do it. So this is why you have to be careful about how much money, how many things you own, because you're going to have to spend money. Have you put money for replacement? Annual obligations. Do you have annual bills, birthdays, anniversaries, a Christmas budget that you're thinking of at the end of the year so that you can start placing aside money on an incremental basis so that when Christmas comes, you can grab that money and use it freely without digging yourself into debt? Medium-term date savings. Do you have a big purchase you'd like to do in the next 2 to 5 years? You want to buy a car? Do you want to buy land? Do you want to do you want to spend on going on vacation? This is what you want to put that money aside. Once you are done with this, then you can go berserk. Okay? If you've done these 6 things before you've done these 6 things before, this now you can go and do whatever you want with your money. You can you can put it in a hill and you can just light it on fire if you want. You've done the important parts to make your life okay. Okay, so that's the important, that this is the budgeting it correctly. This is a budget template that you can follow. If you don't know how to follow it like a movie script, it's much easier once you do it over and over and over and over and over, and you do it many times. You get used to this. You're actually going to become much stronger at it. If you don't have something written, and I know people will say, well, budgets are how you feel about things. You must personalize your budget. Hey, if you've not been good at something your whole life, avoid personalization at the beginning. Follow something. Okay? It'll not feel nice, but just follow. I'm telling you this from experience. I'm telling you this from personal experience. I'm telling you this from professional experience. Do not personalize things at the beginning. Follow a script. You don't know what you're doing. You don't know how to overcome your pains. You must follow a script. When you get comfortable executing that script and you start to understand the benefits of it, then you can start personalizing. But if you've not been doing good this whole time, my suggestion is you don't try and personalize things from the beginning, because it's your personality that got you here in the first place. Right. So let's get into the final part I want to talk about here is cash reserves. So you store money. People like talking about putting money in a bank account is a waste because of inflation. True, you shouldn't have too much money in your bank account because of inflation, but you should have cash because there's some things you need to insure against. Money is a medium of exchange, but it's also an insurance policy. okay, against certain things. So your cash reserve is not just about 3 to 6 months of your basic expenses. A fully funded cash reserve has these 5 components. One, your living expenses for 3 to 6 months, your food, utilities, housing, transport, basic clothes, that is covered. Two times your monthly income based on your health, based on health or out of pocket spending data. So you want to try and make sure that you've got enough money for health expenditures, okay, because health can hit you at any time and you may need to do out of pocket expenditures. If you've got a fully funded insurance policy, go for it. But you may find that the national health insurance policy might make you wait for too long for certain things, hamper your ability to make money or take care of your family, and you may want to have enough cash just to manage yourself for insurance capabilities, just for personal health insurance. Annual special occasions slash funds. These cover things like planned and predictable, often annual events, Christmas, birthdays, anniversaries. You know these things are coming. Register them on a list, figure out how much you're going to spend for each of them, and just pack the money aside every single month. Put it into something very short term, put it into a money market fund, put it into a cash account, whatever it is, but put it somewhere where it's not reachable for these 3 days. Okay, make sure there's a 3-day decision cycle between you and it. Then the fourth one is property and possessions maintenance fund. 3 years or 6 to 15% the replacement value of all your household property and possessions. Your big ticket items that are usually more than about a quarter of your salary. So you're looking at anything like your beds, your televisions, your computers, those things that will cost you a lot to replace. You want to start putting aside 6 to 15% the current replacement value of those things annually for replacement purposes. So you really want to make sure you cover yourself in those areas. So that's why you keep cash. It's also an insurance against the day that thing breaks or it finally gives in and you need to replace it. Property and possessions replacement fund. So that's maintenance. This is replacement now. 100% of the current value. If you're fully funded, you want to have 100% of the current value of those things to replace them. So you want to make sure that you're replacing assets, that you're replacing your household things very well. This is why you should also be very careful about how much stuff you own, because there are costs. Okay, remember there's risk. And on top of this, by the way, you should be spending on insurance. So there's risk, repair, and replacement. Are you able to cover risk? Are you able to cover repairs? And are you able to cover replacement? If you're not able to do those things, then you shouldn't own those things. Okay, ask yourself if you can afford these things. These are usually where people say, I'm struggling to save. And the first thing I'll tell them is you own too much stuff. You own too much stuff. And it's costing you because every time you have to fix that stuff, that's money you could have been saving and investing. But you're not able to do that. Your car is too expensive. Your things are too expensive. The things in your home are too expensive. Okay. And they're costing you a lot, but you don't want to let go of them because you've attached emotional and sentimental value to them. This is where the problems are going to keep coming for you. Okay. So this is what you need to fix. So finally, one of the things I want to try and get through here as well is not wasting money on frivolous expenses. So this is a calculation not many people like, but tough. I've had to have tough conversations with people, so that's life. What should my liquid net wealth be for the car I want to own? Take this calculation down, people. Your liquid net wealth. So here's what you should say. This, and when I say your liquid net wealth, I'm saying your stocks. So get out a piece of paper now. Write how much do you own in stocks? How much do you own in bonds? How much do you own in unit trusts? How much do you have in cash? How much do you have in anything else that is under a marketable security or liquid net wealth? Okay. Now, that number should be more than your age in years times the price of the car divided by 5. This comes from an 80-20-30. Sorry, not an 80-20-30. 23-8 rule for car purchasing. And it's actually based on how much wealth you should also have. It's also called the Millionaire Index in terms of wealth. By the combination of this, it asks you the question of how wealthy are you for the car that you want? Or an inverse in calculation should be, Mike, the car price I have should be less than 5 times my liquid net wealth, okay, divided by my age. So let me give you a simple example so that you can understand this. Okay, and I'm going to explain why I have to use this conversation, why we have to use that calculation. So let's give you a simple example. Let's say you've got about 200,000 kwacha worth of wealth. Okay, and you are 40 years old. Okay, so if I look at your liquid net wealth, you are 40 years old, or you're 30. Yeah, let me say you're 30 years old, and you have 200,000 kwacha worth of liquid net wealth. Well, what kind of car should you have? Well, let's run these numbers. If you've got 200 grand worth of liquid net wealth and you are 30 years old, all right, and you're 30 years old, let's multiply it by 5. 200,000 multiplied by 5 is a million. Divided by 30 is 35,000. So you shouldn't be spending more than 35,000 on a car if you've got 200,000 kwacha worth of wealth at age 30. The older you are, the worse that number keeps getting. So you have to prioritize the wealth level first. Why is this important? Because it's going to affect your ability to maintain that car. You actually have to pay for maintenance. You have to pay for insurance. You have to pay for maintenance. And one day you're going to have to replace this car. Okay, doesn't matter how much of an asset you think it is. That thing is a liability. It's costing you money. It's taking money out your pocket. You have to fuel it. Okay, then the more expensive the car is, or the more luxury the car is, it also now comes with another problem of higher maintenance costs. So let's take a look at estimated maintenance costs of vehicles per brand, so that you can understand what you are buying. When you are buying a BMW and you're going to be driving 1,000 kilometers a month, make sure in your budget you're prepared to put aside 3,157 kwacha every single month for maintenance. You have to be putting that into a maintenance fund, because when your BMW packs up, you're going to feel it. You are going to feel it. Okay, your ability to replace it is going to be hindered horribly. Okay, do you have a Mercedes Benz? Well, you better be able to put aside 2,288 every single month. Do you have a Cadillac? Whatever. I don't think we have caddies in Zambia. Just giving you these brands that you all aspire to. You have a Ford? Better be putting aside 1,614 into a maintenance cash fund every single month. You have a Toyota? Put aside 975 kwacha every single month, so that when the day it has a problem, you have cash to utilize to fix it. That is your insurance policy against that thing stopping working. Okay, so that is what you also need to start looking at. This is why it's extremely important to make sure you are doing the stuff on an affordability basis and not on a desire basis. Okay, we have all made horrible car decisions, but our car decisions stem from the fact that we use our emotions and desires, and people don't like it. I've actually seen comments from adults with children telling me, also, you don't want us to drive. That's why you're telling us such things. Sure. Let's go down that route and see where that ends up. Because unfortunately, where I've come from today is I think we're all tired of the conversation of people saying the system doesn't work, it's rigged, but nobody wants to follow the rules. There are 4 simple rules with money that I've put there. Make it from work, budget it wisely, store it for insurance, and make sure you don't waste it. If you just do these 4 things, you'll often find that it's done, that the rest of your life starts to go pretty well. Okay? The rest of your life starts to go pretty well. If you have an issue where you're holding a lot of cash in a bank account and you're telling me, Munyumba, I haven't allocated it properly, we can fix that in less than a month. Okay? We can allocate that into some bonds very quickly. That's the beauty. Allocation is easier to do when the cash is there. The problem is there's no cash for allocation. The number one reason people don't have any wealth is because people don't manage money. Okay, so let's get the money management part correct so that we can build the wealth correctly. Okay, so that's this part that we just wanted to talk about from everyone. And thank you so much for everyone who's actually been following me this morning. So today I wanted to just quickly share a simple statement by Kevin Samuels, who was the late podcaster, and he said something very interesting. He was talking about something else, but I've just taken out what his quote is as one of the best things you can think about for financial advice. And here's what he says.
But want what you want, but buy what you can afford.
I love that.
So I'm going to repeat that again.
Want what you want, but buy what you can afford.
I love that.
That's what it comes down.
So that's where we're going to try and leave it from there. So let's get these 4 things correct. And going throughout this next month, I'm going to be taking you through the wealth pyramid itself, the base activities that we're going to be talking about. Next week, we'll be talking about insurance, which is risk management. Then we'll also be talking about debt management as well. We'll be going through the cycle of how to manage debt. Afterwards, we'll be following it in terms of tax management, estate planning, and various other things that we'll be looking at. So I want us to really go into each module of this. And today we've dealt with cash management. So take what you can from it, apply it. I'll go through those things one more time for everyone. And I know I've really hopped on these, but the 4 principles I want you to take away from today is money comes from work. You budget and spend it wisely. You store it as insurance, and you don't waste it on silly things. If you do these 4 things correctly, any mistake you make with money going forward, like maybe having it as cash too much and being too conservative, any mistake you make going forward, that can be corrected by just simply taking the next step of investment. But most people cannot build assets because they've got nothing to put into assets. Investment is a hypothetical activity to you because there's no cash to invest with. Okay? So let's actually work on there being cash to invest with. Generate it, allocate it. That's how we get it right. To everyone who's been there with me, thank you very much for joining me. I know all of you have remembered building your career capital, building all these other things. Thank you so much for that. And to everyone, have a wonderful and blessed day. See you tomorrow as we capture assets and not making fear-based investments. We're also going to be talking about anti-fragile investing over the next week.